Good evening, everybody, and welcome to another edition of Thursday Talks, our webinar series that we started in April this year. And we've now been doing this for a couple of months. And we have a fantastic panel today to speak on a subject that those of you who are in business, doing business in multiple countries, might have already heard of. Some of you might have become of the size that this really matters. Some of you might not have really thought that this is of the size that this really matters, but very soon you might be. So without further ado, we'll start off with our session on transfer pricing. With us today, if we can just go back a little bit, with us today we have Therese Garcia, Transfer Pricing from BDO LLP. We have Vinu Subramaniam, Senior Manager, Transfer Pricing from Deloitte, Canada, and Udit Gupta from Legal Partner at Legal Quotient Consultants. And to lead our interactive session, we would have Pramod Goyal, the President of the ICCC. So my name is Vijay Thomas. I am the CEO of Tangentia. It's a technology company, and I'm also the Vice President of the ICCC, responsible for international trade and IT. So international trade and transfer pricing, I think, go hand in hand, and it's something that we truly appreciate the time of our panelists to come in today. So what will we be speaking about today? We would have an interactive session. We'll have panelists having their own presentations. Therese Garcia, Vinu Subramaniam, and Udit Gupta would be speaking. We'll give them around 10 minutes each for them to give their view on transfer pricing. There's been some changes in the Canadian rules around transfer pricing. There are changes, and what they think about the future, and how should people be cognizant of transfer pricing mechanisms and the legal aspects of it. And then we have our very own Pramod Goyal, who the president of ICCC, who's also a chartered accountant and a financial expert, that will be asking questions to our panelists. And then we'll have some concluding remarks. We will also take questions from the audience. So if any of you have any questions, please send in your questions through the audience on Facebook, and we will take those for our panelists. Moving on, I would like to mention this. This is something that the ICCC we take very seriously. We have the ICCC Small Business Assist program, but if you're a small business and you need assistance on any subject, I mean, because we have a lot of people on our board within our organization that are experts in different areas, and so we have a volunteer board that will take your questions, will speak to you for 30 minutes for free. And then, in most cases, they will be able to give you some guidance or even be a sounding board. So to do this, you got to just send an email to iccc@icconline.org and just type in Small Businesses Program, and we will assist you guys. So moving on, the disclaimer here. So the views expressed of speakers are their own personal opinion and do not necessarily reflect the official position or policy of the ICCC. And these are does not constitute legal or professional advice. So moving on, we will move to our first speaker of the day. Our first panelist, Therese Garcia, Partner Transfer Pricing. So over to you, Therese. And Therese today is going to be talking about what is transfer pricing and why it is important. So over to you, Therese.
Thank you so much, Vijay. It's great to be here, and thanks everyone for joining. I just wanted to introduce myself a little bit in the next slide here. So I'm a partner at BDO, as Vijay mentioned, specializing in transfer price. I've been with BDO now for a little over 12 years, and I've been practicing transfer pricing for a bit over 15 years. So when I'm not helping my clients with transfer pricing and defending them in the eyes of the tax authority, I am an avid runner. I actually train for marathons. I spend time with my son, pictured in the slide there, and we go on wagon rides to the zoo. And then before COVID-19, my husband and I and my son were very intense travelers, and one of the most memorable trips was our trip to India, and we've actually been there 3 different times, and our favorite was going to go on Quotient, and in Quotient we did a houseboat. We stayed in a houseboat, excuse me. So it's very close to my husband and I. Is we want to definitely go back. So for my portion of the presentation, I want to talk about, as Vijay mentioned, what is transfer pricing, what's the basics of it, and why it's important. And then I actually left the more complex issues and considerations my colleagues Udit and Vinu today. So let's get started here. So just in general, who's looking to expand into India in the world, all if India maybe already operations in India or elsewhere in the world, then and what is transfer pricing? It's really about the pricing of related party transactions. So it's really the most common scenario is, you have a Canadian parent company, for example, with perhaps a related party or a sister company or subsidiary in India. So that's kind of the very common scenario that I deal with for many of my clients. And so the reason why transfer pricing is important is that the pricing of these transactions between related parties need to be done correctly and in accordance with the various transfer pricing rules in the jurisdictions. So for the CRA purposes and also in the Indian tax authority, for the Indian tax authorities. So in the prior slide there, I had mentioned, well, many companies, rightfully so, may want to be very aggressive with their transfer pricing in that they want to shift profits to the lower tax jurisdiction. And that's certainly something that many tax authorities scrutinize. That's why it's critical to really have your transfer pricing in order to kind of support your positions. So the key principle of transfer pricing is really to price these related party transactions as if the two related parties are completely unrelated or they're operating at arm's length. So oftentimes many of my clients tell me, they do price the transactions as if they were, a third party customer, for example. And internally, when I hear that, I say, that doesn't sound unreasonable. That's actually excellent. But now it's really putting together the appropriate analysis and documentation to substantiate and support that, and so that it's defensible in the eyes of the tax authorities. And Udit will be getting into that in a little bit here. So as I mentioned, this transfer pricing is really applicable to companies who are operating across the border and who have, of course, related parties. Earlier that your company right now may not have the dollar value of the transactions going across the border, or you may not be big enough perhaps, but transfer pricing is certainly something that you might want to think about in the back of your mind and to consider that as soon as you start crossing that border, this is something that you need to consider because it is on the radar of the tax authorities. So moving on here, let me see here. What are the types of transactions you might be asking yourself? Well, that fall in the realm of transfer pricing. So really, it's any and all transactions. The most common ones are the transfer of tangible product going across the border, also intangible, so perhaps a license of a technology or a trademark, or perhaps manufacturing processes. That's a very common transaction as well. And in that case, you would be the pricing would be something along the lines of perhaps a royalty payment to the actual owner of the intangible property. The third type of a very common transaction is intercompany services. And so for many of my clients actually who have operations in India, this is the most common type of intercompany transaction where there's services being rendered between Canada and the US. So one of the common ones that I'm helping one of my clients with is India's rendering technical support services to the Canadian company. And so these technical support services are really to help this Canadian company fulfill its customer contracts here in Canada. And so that service is really in the realm of transfer pricing, where India needs to charge Canada some type of service fee to compensate itself for rendering these services. So that's, again, part of the transfer pricing exercise. And then, of course, there's also the last three types of transactions, which are cost reimbursements, financial transactions. So even intercompany loans are of the subject or part of the transfer pricing umbrella. And also, finally, any type of business restructurings, if there's a sale of equipment or a whole transfer of, let's say, an operation or function of an entity, that would be subject to transfer pricing. And so if we move on, this is kind of the last part of my segment here. It is some takeaways for you in the audience from this presentation, in that I've provided you kind of a general overview of what transfer pricing is, why it's something you need to kind of put in your mind to look out for as part of your operations. But transfer pricing and the exercise behind it is really to help mitigate your risk so that you are prepared for a tax authority audit. The second thing is that it does provide many companies with a tax planning opportunity, and it could really help you reduce your global tax burden. You know, in the reality we're in, many companies want to save their money, and they want to ensure that they are paying the least amount of tax globally. And so transfer pricing is really a mechanism to help many companies do this in an effective way, but also within the realm of making sure you're in the correct in the eyes of the CRA and also from the Indian Tax Authority. So one example that comes to mind is that, you know, the Canadian corporate tax rate is in around 26.5% right now. And I think India was reduced from 30 now to 22, I think, in and around the corporate tax rate. So there is that tax differential. It's not huge, but that could be a determining factor to say, hey, maybe is there a way to do it with transfer pricing to help you shift some profit into India to save on some of that tax. So again, that's very high level. I just wanted to give you that example in your mind as to why transfer pricing is important. And then finally, if the decision is made to sell, you know, your company in whole or in part, transfer pricing is something that certainly you want to look out for well ahead before you do this, because you don't want any type of transfer pricing or tax exposures to come to light when you are in the situation where you're looking to sell. So now I'm going to turn it over to my colleague Udit, who's going to kind of go into the more details of the legislation behind transfer pricing in Canada.
Yeah, so I think we'll start. We'll move to Vinu. So Vinu is going to speak about Canadian transfer pricing, an overview. Vinu is a senior partner at Deloitte, and we'll have Vinu over now. So over to you, Vinu.
Thanks, Vijay, and thanks, Therese, for a good presentation and a good overview and a setup. Just to introduce myself to everyone, I'm Vinu Subramaniam. I'm a senior manager in the Deloitte Canada practice. I'm based in Ottawa. I've been with the Canadian practice for I don't know, must be about eight years now, and I've been with transfer pricing all my life. I've close to 15 years, 12 to 15 years in transfer pricing. So fairly long amount of time just doing transfer pricing. From an educational background, I have a master's in economics and finance, and that's where a lot of my efforts go in interpreting how the legislation can be applied from a very economic perspective, and advising clients through litigation, through audits, and that's where our complete focus is. So in today's session, I have probably one of the more easier portions of the presentation. My section simply deals with what the transfer pricing regime is. I have been with the Indian practice. I know the Indian regime, and I know the Canadian regime now, and it's quite opposite. The Canadian regime, transfer pricing regime, is very minimalistic. The slide that you're seeing, if you can move on, yeah. The slide that you're seeing, these are, moving on to the next slide. Yeah, these are the four relevant, Section 247, 447 of the Income Tax Act. It encompasses almost everything that is there with respect to transfer pricing, and these four subsections run to Section 247.4. So Section 247 is what is relevant for transfer pricing. Very minimalistic. This is how Canadian transfer pricing has always been prior to Section 247 being introduced. They don't say too much, but they endorse the OECD guidelines that further explains it. Taking you through some of the sections that are relevant here. 247.1 deals primarily with definitions, provides an explanation of what is arm's length, very much related to what Therese just explained. I have it in a little more detail in the next slide when I talk about OECD. What is transfer price? How is prices between two related parties? And in this case, it's not domestic. It is one related party has to be a non-resident. So when a transaction between a Canadian taxpayer and a non-resident entity is considered, it's not between two. Transfer pricing 247 section does not apply when you have transactions between two related parties within the same jurisdiction, although the principles still apply. Documentation, due date, these are some of the relevant definitions in there. Transfer pricing documentation is required to be prepared. From a Canadian perspective. Unlike India, where the documentation is required to be prepared annually, here there is no annual requirement, but at the same time, documentation should be maintained. Effort should be made to ensure that the transfer prices that's being agreed and documented follow the principles of arm's length. The documentation is due at the time of filing the tax returns. So when the Canadian tax returns are filed, so if you have a December year-end tax returns will be filed in June, 6 months after. Because of COVID, there's been some extensions. So June, July, and August tax return deadlines have been extended to September. And that's it. I don't think it is any further extensions. That's 247.1. 247.2 is one of the more most important subsection within 247. This deals with transfer pricing adjustments. This section gives CRA, the Canadian Revenue Authority, the power to make adjustments. So there are two key subsections under 247.2, 247.2A and C. This relates to normal income and capital adjustments. If the terms and conditions differ from what an arm's length entity might be entering into, CRA views that as an issue. CRA could automatically make upward adjustments. Subsections 247.2B and D deal with recharacterizations. These are a little more, these are a little difficult and rare adjustments to be made. I mean, CRA does take the onus of doing recharacterization adjustments, but it's been till now not being held up in courts. The two important conditions for recharacterization. One is that the current transaction as it is would not be accepted by third parties. When I say that, it means that the transaction by itself, not just some terms and conditions, will not be accepted. The whole transaction will not be accepted by third parties. And there is no bona fide reason for this transaction to happen other than just to gain a tax benefit. So the real characterization of the entities is different, and the objective was to do something else. And that's, if CRA finds that out, they can probably recharacterize. It's a very, very difficult and challenging section to apply, and CRA has tried it in several instances, very litigious. CRA is not obligated to accept taxpayer-initiated adjustments if there is a voluntary disclosure or an amended return that's happened. CRA can still audit it. That's supposed to be kept in mind. 247C deals with penalties. Penalties happen when is applied when transfer pricing adjustment exceeds the lesser of 10% of the gross revenue of the Canadian taxpayer, or 5 million. So for example, if your adjustment is about 10 million transfer pricing adjustment, then penalties will apply automatically. Or if it is 10 million, but it's lesser than 10% of the gross revenue, then whichever option applies first and the threshold gets exceeded, based on that, penalties determined. But penalties do not just apply automatically. If you have maintained documentation as required under 247.4, then penalties would be reviewed to see if reasonable effort has been made. If there is no documentation maintained by the taxpayer under 247.4, then there's a higher likelihood of penalties being applied. Penalties equal 10% of the transfer pricing adjustment. So if it's a $10 million adjustment, then 10% of that would be penalties. This is non-deductible and this is payable. This cannot be held back, or even if you are contesting the penalties. Adjustment can be appealed through normal objection and appeal process. 247.4, again, a very important section that deals with documentation. It outlines what's required in a documentation. This is the legislative minimum that needs to be maintained. It's quite broad, but they clearly say this is the legislative minimum. By complying with 247.4 requirements does not mean that you would be out of the penalty threshold or penalty clause of 247.3. But by not complying, you would definitely be more liable towards penalty. The penalty is a combination of meeting the legislative minimum requirements and showing reasonable efforts. Reasonable efforts is not clearly defined in the law, but it's been discussed through a few cases, and it's been outlined in some of the transfer pricing memoranda that's been issued by CRA. Moving on to the next slide, please. So apart from the legislation, that is section 247, which has four relevant subsections, there are a few documents that are available on the CRA website that can be used as guidance. There was a very, very, very strong document, IC87-2R, which almost was an explanatory summary of how section 247 is to be viewed by the taxpayer. The CRA has withdrawn that as of December 30th, 2019, and we cannot rely on it because there's going to probably be some updates, and CRA suggested that we rely on the OECD guidelines and other transfer pricing memoranda that's there on the website. There are some guidance for competent authority. There's some guidance for advanced pricing agreements. There are a few transfer pricing memoranda. It's a series from TPM 2 to TPM 17. I won't go through all of them. It's there on the website. Just couple of important ones I wanted to touch on. Reasonable efforts in TPM 9, which explains how is reasonable efforts viewed by CRA as we prepare documentation. Very briefly, reasonable effort means that when you set up a transfer price, have you put in reasonable efforts to think about the transfer price and consider, and when it's implemented, has reasonable effort been maintained to make sure that it meets the arm's length criteria? So it's a well thought out argument that can be brought out in the documentation. Then there's a good chance that the penalty can be addressed. There's also one more TPM I wanted to quickly touch upon. That is TPM 17, more relevant for the current COVID scenario. There was a webinar by IFA recently where one of the CRA Director General referred to the TPM 17, which deals with government assistance, and maybe Udit might be touching upon it later on, but it just deals with how cost-plus entities or service entities should be pricing the company charges. So if the Canadian subsidiary is or the entity is receiving wage subsidies or some form of grants or some form of government assistance, how would that subsidy or grant be addressed when you're computing your transfer price or the cost plus markup? Do you include that in your cost base? Do you keep it outside? And TPM 17 addresses that. TPM 17 says that you should not include it in your cost base, leave it in Canada unless you have arm's length evidence to prove that it's been addressed. And CRA has confirmed that TPM 17 applies in the context of COVID scenario. There's no specific guidance by CRA on COVID-related matters except TPM 17. OECD guidelines, CRA has endorsed the 2017 OECD guidelines. The BEPS action items has also been endorsed by CRA. As far as I know, OECD is working on COVID pandemic-related paper, which should probably be out by December or early next year, and that should probably be considered when we look at transfer pricing matters. OECD also addresses arm's length principle and arm's length methods. I won't go into arm's length principle. Therese has already addressed that. Arm's length methods, the standard methods are the traditional method and the transactional method. The traditional method is CUP, which is price-to-price comparison. Resale method is normally, as recognized by CRA, applied in where the Canadian taxpayer resells a product, does very little value add. Cost-plus method applies in terms of services, wherein cost of services are marked up, or in manufacturing type transactions. Profit-based method is TNMM, and profit split. Profit split gets applied in more complex transactions. TNMM is normally a method of last resort, wherein we test the overall profitability. Quickly moving on to the last 2 points. Other reporting obligations, wanted to highlight Form T106 is reporting requirement in Canada. This is very similar to Form 3CEB that's there in India, but Form 3CEB is prepared in India for every rupee of transaction that happens, but Form T106 is only required if the total reportable transaction exceeds more than $1 million Canadian dollars. Total reportable transaction means all transactions summed up with all non-resident entities. The form has a slip and a summary wherein you outline the details of the non-resident entity. There are a few court decisions, not many, unlike what I've seen in India. There's been a series of decisions and counter decisions, but there's only GlaxoSmithKline is the Supreme Court decision, is a landmark case. The more recent ones are Cameco, it's a federal court decision that deals with Re-Characterization, sham, and how transactions are supposed to be viewed. Very interesting decision if somebody wants to read it. Agracity is something that just come out a week or so ago that lends itself a lot from Cameco. Very interesting decision to read as well. So that's it. I think that's all I have. And I'm sorry if I took a little more time than required. Passing it back to Vijay.
Yeah. Thank you, Vinu. And if anybody has any questions, obviously we'll go into a little more detail when Pramodji is having a conversation with you as well. So we will move to our next speaker, who is Udit Gupta, who is a partner at Legal Quotient Consulting. Udit will be speaking on the impact of COVID-19 on transfer pricing. So over to you, Udit. Udit, I think you're on mute.
Okay. Yeah. Thanks for your kind introduction. First, I would like to apologize that on the social media, my profile went as a senior partner. I'm just a partner, recently been promoted as a partner. And I'm having a 14 years of experience in tax, in which I was doing direct tax, indirect tax, and transfer pricing. And I'm having an experience of 8 years dedicated to transfer pricing. and I have been looking after the legal quotient consultant transfer pricing team for India, for Southeast Asia, for US and Canada. Prior to that, I have been working with Deloitte Kuala Lumpur, and I have been working with Ernst & Young India. So directly, without wasting any time, because it's a complex topic and I will need some kind of a time. So I will directly jump to the topic. What are the impact of transfer pricing on, what are the impact of COVID on transfer pricing? So I have divided my presentation into three parts. First of all, we need to understand what the business models, how the business models evolved, and because of the evolution, what the effect on the risk, which later on the later part the companies came to know about. Because of this, what the impact on this different models are. And the third one I will be taking upon for the transfer pricing risk because of those business models the companies are facing. So first of all, going to the business models, first of all need to understand that how the business model involved. For this, firstly I will need to go to the ancient time when every person was doing everything. Each person was doing his own farming, was doing own hunting, was making his own tools, was making his own home. Then from there they shifted to barter system. They find a specialization into each individual, what the each individual is specialized into. Like if some person is specialized in making the tools, that person was making a tool, some person was good in making the clothes, he was making the clothes, and the person was exchanging the goods between each other. And likewise, then there is involvement of currencies, and because of the currency, the trade started happening between the cities. Then there was invention of wheels, and because of wheels, they went extra way. That then they went into the states, and then there was invention of ship. The trade started happening between the countries, and then there was aeroplanes and all. From there, the MNCs, the multinational enterprises came into the picture. And like how it started, there was a family business. Like suppose we can take example, hypothetically we can take example of Sony Japan was started in Japan, and when they have to start up a business and they want to expand to different countries. So how it started, that they replicate the entire structure to North America. They will be having a manufacturing unit in Japan, they will be having a trading unit in Japan also, they will be having an accounting team in Japan. Likewise, everything will be replicated in North America. They will be having a manufacturing unit in North America as well. They will be having a trading unit in North America. They will be having a R&D team over there. They will be having a accounting team over there. So like this, previously this was a decentralized model, which a company in starting with the M&E started with. And then like in the Asian time, with the persons came with the specialization, the countries also came up with the specialization, which MNEs identified these countries are more good. Like they identified China is more cheaper. It's very good to manufacture over there because there's a cheap labor for the production. They further identified there is more skilled labor in India, where they can shift their all the back-end works like software development or the R&D or the other accounting works. They can shift it to India, and they find like, okay, they can put an advertisement team in Singapore, and they found that they can put a trading team, they can put their trading structure in Dubai for easier access to everywhere. So this is how and this is called the centralized model. And because of centralized model, everything was been disintegrated, which previously was confined to each country and which were replicated to each country. And because of this, there were different kind of a risk which company identified, which company have exposed to after the COVID era. Next slide, please. So the company identified there are different kind of risk which the companies are facing because of this centralized structure. The first one is supply chain disruption. Like suppose for example, like BMW Germany is having a manufacturing unit in China who are making the body. In India, they're making a chassis, or India they're making a gearbox. In Vietnam, they could be making a car engines. In Japan, there could be a car seats will be there. So everything was manufactured in different places, and suppose from there everything was going back to Germany, BMW Germany, and the cars were assembled over there. And what happens is, like when the pandemic hit China, the entire country went into the lockdown, and the car body they were not able to manufacture the car body. And so what was the way around? So now they went to then India went into the lockdown. So there was a complete supply chain disruption, and because of which now the company will have to restructure their transactions and all. And now they come the market risk. Now because of the job loss, because of the lockdown, the companies are the individuals are spending on necessities rather than on luxuries. So and further there are travel bans and all, because of which the company are not able to because of which the individuals are not able to spend money on the travel, and also there is there is very less demand of the products. And the third one is credit default risk. We are expecting, and we can see also there are a lot of insolvencies coming in the market, and we are in future also, like there will be a lot of bankruptcies, which previously companies haven't interpreted or haven't been thought of that this situation will be coming. Not a confidentiality risk. Previously, what was happening, like around the previously the structure was the servers were made in such a way that 10 of the employees were generally working from home and 90 were working from office. So the servers were having a limited capacity. But as the pandemic hit, there was a sudden lockdown. There was not such kind of infrastructure. So the every employees who's because of this disruption in free flow of data, the employees are using their own personal networks. They could be using their own personal IDs. So there is a confidentiality risk which the company is faking. Further, there is a capacity utilization as well. Like there are hotels which are which are which they have to incur. They are still incurring the fixed cost, and they are not having any revenue per se. Further, there is aviation industry. Like there are many industry, like car manufacturing, car industry. So they are having an unutilized capacity which they are not able to utilize. And further, there's a liquidity working capital shortage as well, because the company needs fundings and banks are not providing because of the insolvency risk. So ultimately, there are a lot of the transaction happening in between the subsidiaries. There are the corporate guarantee being provided by the headquarters, or like the revenue or the loan are being provided by the headquarters. And further, that the further risk is like the invoking the force majeure clause in the contracts. What is happening is, like, you have entered into a contract with the unrelated party, and to complete that contract, you have further entered into sub clauses, sub contract with the unrelated parties. And the unrelated party, many of the unrelated party are raising their hands. Okay, they won't be able to fulfill the contract, but ultimately you are still bound by the ultimate to the unrelated party. You are still bound to provide that service or to provide that. To fulfill that contract with the unrelated party. So that is again the bigger risk coming to the market. And there is again a foreign exchange risk, because as you can see from dollar to CAD, it's going from 1.30 to 1.45, then again going to 1.3, and like it's still in developing countries still less, but in developing you can see there is a fluctuation of 5 to 10%, and which is the overall margin. If any service line or if any manufacturing, if there is an increase in a cost of 5 to 10%. So this is a major issue that what the companies are facing. Going to the next slide. Next slide, please. Next slide. Yeah. No. Yeah. So now we've seen like how the business is involved and how the risk, what the business, what the risk the centralized businesses are having. Now we will see what the transfer pricing risk are coming because of those risks. Because ultimately risk and transfer pricing goes hand in hand. The more will be the risk, the more will be the transfer price. So the first one is the restructuring of supply chain. Ultimately, as I told you, that like there is a blockchain. The first thing is that company will have to remove that blockchain, and for that they will have to restructure their transaction, or have to restructure their supply chains. For that they will have to revoke their original contracts and have to enter into with other persons as well, and for that they have to compensate. And the other was remunerating the low risk entities. Low risk entities are like you have set up the like BMW Germany has set up their manufacturing unit in China, which are manufacturing. They are acting as a toll manufacturer. They are acting on their guidelines. They are procuring the raw materials. They are procuring the labor. Whatever they are doing on behalf of BMW Germany. And when there is lockdown, they are still required to, as per China government, they are still required to pay to that entity, and they had to show a profit over there. So this is again a very bigger risk coming in transfer pricing. Then coming to the advanced pricing agreement, there has been an agreement between between the taxpayer and the government. Okay, like suppose BMW Germany has entered into a agreement with the Chinese government. Okay, whatever the manufacturing we are doing over there, we will be providing this much of an amount to our related parties, to our BMW China unit. And for that, and they have already ended up. But if there is a lockdown, you can enter into, if there is a lockdown, the company can ask for like they will have to again renegotiate the APAs with the government. So again, APA things which have already been taken into place need to be reconsidered. Next slide, please. So, and there is an intra-group financial transaction. Ultimately, as I told you, the banks are hesitant to give loans to to the corporates because of the low credit ratings in this pandemic situation. They are playing pretty safe because the companies are going insolvent. So there are intercompany bank transaction or there are corporate transaction happening between the companies, and for that it's very important to see that whatever the transaction happening is happening at the arm length price. And further, there is a comparability. Like in transfer pricing, there are two kinds of comparison which we generally do. One is a price you are paying to the related party, one you are paying to the unrelated party, and another one is margin. In margin, you generally take the comparable company, what you are earning and what your comparable companies are earning. In your earning, like if you are into the automobile, paints, and into the chemicals, and like previously we were taking a comparable company who was into hospitals, into chemicals. So the hospital chemical will be having a higher margin and your margin will be completely distorted because ultimately the automobile industry is at the very low at this time. So we'll have to choose your comparable very carefully. And likewise, the multiple year data, previously we were using your margin earned by your company vis-a-vis the margin earned by comparable company. And usually we were taking the 3 years comparable margins because because the current year margins were not available for the company. Thirdly, to complete the business cycle, and this year comparable margin will be pretty less in comparison to previous 2 years. And if we take the average, the margins will go on the very higher side. So a single year margin is pretty. You will have to see how to, because in some of the countries like in India, you're compulsory required to go for the multiple year margins. So we'll have to see how to strategize it. And the second last is TP adjustments. There are a lot of expenditure which the companies are incurring, and you will have to see while making your transfer pricing report and to have to make a presentation. This kind of expenditure was very unusual in a way, and because of the lockdown, this was happening. This was a forex loss, or this was a like inventory was supposed to be write off. So we'll have to take that cost as well. And the last one is valuation of intangible. There are 7 or 8 methods on which the valuation is being done, but generally we are always used to do it by discounted cash flow. And discounted cash flow, we always predict what the future revenue could be, and on the basis of that, you are predicting the company's revenue, whatever your sale purchase is happening between the companies or the intangibles are being sold between the companies. And because of that uncertainty, because you can certain a value at this point of time, but you don't know when the vaccine will be coming. If the vaccine comes after a month, the valuation can go valuation go altogether a different place, and if the vaccine come after a year, the valuation can go to at a different place. So cash flow you cannot predict at this point of time, but you have to make a robust documentation to show like whatever you have prepared at this point of time, whatever the transaction be done has been done at the arm length price. I'm sorry because this has been pretty technical and I have to complete it, so I'm not sure, but you can revisit the video.
Yeah, so thank you very much, Udit. I think that is quite comprehensive. So we will get to more details as we speak on the subject, and with that, I'd like to invite Pramod Goyal. Pramod is the President CEO of Canada Wide Financial Corporation, and more important to me, he is my boss. He is the President and Board Chair of the Indo-Canadian Chamber of Commerce. And so over to you, Pramod. And Pramod, I think we've got an eminent panel here, and I think we've also have a lot of people on Facebook watching. So I think they're all looking forward to your questions. Over to you, Pramod.
Thank you, Vijay. A very good afternoon to all those who are associated with us on this webinar this afternoon. I would like to extend a warm welcome on behalf of the Chamber to our esteemed panelists once again. All the 3 presentations have been quite informative, and I guess people who are aware of the concept and the transfer pricing, for them, they would have a brief idea as to what it is. But for somebody who is watching it for the first time or not aware of the concept in total, it might seem to be exhaustive. But let's spend some time to interact, and so that some of our audience is able to understand the subject in finer detail. Let me begin with you, Therese. In the introduction to the subject, you explained the concept and how the transfer pricing normally would work when 2 countries are involved. But given a situation where multiple entries or multiple jurisdictions are involved, how would it change the dynamics of the entire transfer pricing issue?
Right. No, that's a great question. I think, and for the most part, when you're dealing with multinational companies, you have, for example, a head office in Canada with, so not only in India, but you have the UK, you have perhaps Germany, Australia. And so that does get a little bit more complicated. But in terms of the underlying principles, the transfer pricing kind of arm's length principle still remains the same. Now, a lot of the, if multiple jurisdictions are involved in a transaction, so for example, perhaps there's tangible product purchases coming to and from Canada and India, and then there's the UK and Australia. Typically, all tax authorities would like to see it a transaction by transaction basis. So the exercise does get a little bit more complicated, but it's certainly a very common occurrence. And a lot of the times, although it could get a little bit more complicated, the analysis and the thought behind it, you could roll it into or apply it to the other transactions.
Thank you, Therese. Yeah. Moving on to Vinu, I understand you were mentioning in your presentation as well that there were some recent developments with regard to changes in the Canadian transfer pricing regulations. And I think as of December 2019, CRA had cancelled the earlier published information circular. And then they did not come out with a replacement. Rather than that, they came out with a couple of bulletins and some information was given in. So in terms of guidance or what we're looking forward in times to come, what are the expected changes that you think are likely to be introduced in the new information circulars that would be coming in?
Sorry, I forgot to unmute myself. Thanks, Pramod. That's a good question. Yeah, it's not yet entirely clear what and how long would they take to reissue or revise the 87-2R. Probably at this point in time, a lot of some of the court decisions that have come out with respect to how the Canadian legislation has to be interpreted have not entirely been in CRA's favor and more in the favor of the taxpayer, and this gives CRA an opportunity to revise and reflect some of the more OECD concepts into its guidance, which it is already doing it more in practice. So it'll be interesting to see how the revisions look like. But yeah, I mean, I would see, like, for example, very recently the Agracity decision. Some of the and I'm jumping very on topics, but the way Canadian legislation or the Canadian transfer pricing is sometimes seen as form over substance. I mean, it's more legal form over economic substance, and OECD tends to move more towards the economic substance rather than just confining itself to the legal form. The Agracity decision, I felt like it's a good read. One of the expert witness on behalf of the CRA was one of the people who were there on the panel for the OECD Working Committee, and that person had a lot of OECD-related influences and comments, and the way everything should be viewed, and a lot of that was not really captured by the court in its decision. The court did reflect on some of them, but it eventually decided from the perspective of a legal framework, which is somewhere I would say would reflect some of the changes that we would see in the IC 87-2R in the time to come. So yeah.
Okay, thank you, Vinu. Let me ask Udit, the impact you were talking about COVID-19 and its impact on transfer pricing or the risk assessment. So as we all understand, the impact has been devastating on all sectors of the economy globally. So businesses will have to adjust their transfer pricing, I believe, to reflect the changing economic circumstances with maybe limited real-time data on comparable entities or transactions. In your opinion, Udit, what sort of relief can companies expect on transfer pricing issue because of the setbacks they may have faced because of the lockdown?
First of all, I would like to start with, I have seen like my experiences, I have worked in like 4 or 5 countries, and my experiences in Canada, where I have specifically felt like in India, we are compulsory required to file Form 3CB over there on a single amount of transaction itself. But in Canada, like you are supposed to file a form at after a 1 million or threshold. There is a threshold, and there is no like there is no such harsh rules for transfer pricing. What I understand, like in comparison to India, there are huge penalties. There are huge penalties. So everyone doing a transaction, international transaction, are tend to take it very seriously. And like in Canada and especially in US, the penalties are on the addition in rather than in non-compliance. So people are not taking that much seriously. But what I understand, after 2 3 years, once, because there are profit, there will be huge losses in the company, and like and there are a lot of low tax, like as Vinu also mentioned, like it's called low risk entities. So this is a major area, and in almost all the countries in which they are operating as a low risk entity. So that is a major thing which I think which will be a future litigation point will be coming. And after a certain point, each country will be fighting for the tax, and the issue will be coming after 2 to 3 years. Like because generally government takes up the case or CRA takes up the case, and we are generally talking to them. Like it's always happened after their case is picked after 2 3 years, and when the case is picked up, then client run to make up the documentation. When the case is picked up, when the case comes, they're not having the facts, because if I will making a translation document today, I will be having a more facts in comparison to if I will making a transfer documentation after 3 years. And so something very important on today's date, we are supposed to, it's very important for each client, they should prepare a transmission documentation, and they should capture all the facts which are happening in their industry, which are happening in their business, because of which they are entering into the losses, because of which they are restructuring their transaction. And if they will do it after 2 to 3 years, they will not be having that facts, and they won't be able to present to the CRA. First of all, what CRA will be doing is something different. What the incentives they'll be providing to the client is a secondary. But first of all, client itself should be very much taking a proactive actions from the transfer pricing side, because I think this will be the next big thing will be coming in the market, and ultimately each country will be fighting for the tax to increase their revenue. And from the CRA side, we are already, like, I had a word with CRA, like I had a word with CRA in Malaysia, in Canada, in India. Each one is waiting for a time, and they are seeing like they are what the word we have with them, what their conclusion is, what they are interpreting. They are just waiting for the time, and they will look for the industry, how the industry has been impacted, and accordingly they will go. If they see like that 10 of the companies have done good, if you are not done good, 2 or 3 are now done good, then they will be after the life of those 3 companies. There will be short addition. So they are just waiting for the time and will look after. So they are also like in transfer pricing, I have seen in comparison to the other tax officers in transfer pricing, especially in India, there are more educated and the more IAS officers. That ranking level is very high. Over here also the persons are very on the very high level, so they also tend to very well. They are very much educated in sense. So they are just waiting for the time, and what we are getting from them is that they will be also waiting for the time, and they will see how the industries are going. But as such, I don't think nothing will be coming a relief for the industry. If for ultimately everyone want their pie of tax.
Okay. Let me bring Vinu on this. Udit mentioned about compliance and penalties. And what I heard was that, as per him, Canadian provisions for penal provisions are not that stringent comparatively as other jurisdictions that he has faced. So based on your own professional experience so far, with regards to compliance and penalties within the Canadian landscape, what would you say? How is it practically?
Thanks, Pramod. And I understand where Udit is coming from. I mean, I have seen the way Indian regulations go after, and you know, it's far more litigious in India than in Canada. I mean, there's an option to settle, and a lot of things happen in Canada, which probably follows a more hierarchical process in India. But penalties are, and based on my experience, and when I speak to clients who are multinational companies in the US, they find Canadian penalties to be very stringent. And especially the way CRA applies it. I mean, an adjustment over 5 million automatically gets a penalty, goes to the TPRC committee. TPRC is a transfer pricing review committee. Oftentimes, transfer pricing review committee, if the documentation is not there, confirms your adjustments, and the adjustments then go into an appeal process by itself. We've had success at the appeals level for penalties that have come in, but it's a process, and it's a very extensive and an expensive affair for the taxpayer. Documenting and managing your documentation is very important, and it's very essential to avoid penalties, because penalties, once they hit you, there is no escape from the penalties. There's a cash outflow. It's not like a TP adjustment which is just, you can get that covered through a mutual agreement procedure or a competent authority process. Penalties are penalties. It's a cost and it's a cash outflow. So it's quite stringent on the taxpayer.
Okay, thanks, Vinu. Okay, Therese, if I could ask you this. Now, as we see, I mean, we're just talking about the result of the economic fallout, and as a result, there would be companies who would be looking to adjust or make adjustments to the transfer pricing. So how easy or difficult would it be for the companies to adjust their TP policy, or in justifying that change, if it is significant, to the tax authorities? That is one. And part B of the question is, how would the tax administrators or the regulating bodies going to react to this significant TP change, if there is any, and in the absence of any past statistical data or reference points?
No, thanks for that question. So in terms of the first part of your question about, how easy is it to make a transfer pricing adjustment given the economic circumstances, and even prior to COVID-19, some of my clients, the reality is they have made transfer pricing adjustments, like a year-end transfer pricing adjustments, just given perhaps their business situation, the economy at the time. So I would probably say it's certainly, I wouldn't say it's easy, but it is doable. I think the critical thing is preparing the transfer pricing analysis and documentation and support to substantiate why you're actually why there's a change this year from the prior year, for example. Because I know many clients and taxpayers perhaps don't touch their transfer pricing. It's not ideal, but they don't touch their transfer pricing on an annual basis, even if it's, the CRA rules do say you need to actually do formal analysis and documentation annually. So it's even more so critical to do it in this 2020 taxation year and even 2021, so that as part of the documentation, you can tell the story, if you will, as to why you needed to make some adjustments or why you're moving kind of the margins differently in comparison to prior years. Does that, I guess, clarify the first one?
No, for sure. Yes. Yeah.
Okay, perfect. And then in terms of your second question, I mean, that's certainly a question in all of our minds, us as practitioners, and even and of course our clients and taxpayers in general. How are the tax authorities going to react? Right now, the CRA has pretty much been silent on their positions. I think it's still fresh, with the exception of, I think, Vinu, you mentioned the bulletin on the government incentives, but I would probably take it as, we as practitioners and as when we're assisting our clients and even our clients, is to really take a practical approach and determine, why we doing? Why are we making the adjustments we are? Is it for the benefit of the company as a whole? Assuming that it is for the benefit of the company as a whole, and again, putting the analysis in place, and perhaps some of this analysis for this COVID period will not only include kind of your basic transfer pricing, benchmarking, for example, but also even analysis of the industry that companies are operating in, and perhaps looking at even long-term projections as to, what does this actually look like? So one of the strategies I'm taking with one of my clients is, we're looking at that data to determine, okay, this is why we're justifying the price, the transfer prices this COVID period, and even telling the story as to, what this is going to look like for future years. Right? Because it's quite possible that that some companies will be in losses for longer than 1 or 2 years, given because of this significant impact.
Thank you. Would you like anything to add, Vinu, here on what Therese said?
Yeah. I mean, I completely agree to what she has said, and this is exactly what we are seeing a lot from a client perspective. Mostly, documentation is to be maintained, at least reviewed and looked at it, and especially this 2020 year is a little different from the years that's gone by. The economic circumstances is quite different because of the COVID and the pandemic. So it makes sense to reflect if your transfer pricing is correct under the current circumstances. A lot of what Udit said earlier very much is relevant and applies. You should look at your business model if it makes sense. A lot of the times we had scenarios like the lockdown, the business is shut down for 3 to 4 months. What does that mean? How does that impact? Do you still pay a cost plus whatever 5 or 10% to your related party? And do you just follow your transfer pricing policy? Does that make sense? Who bears the risk? Where does the risk sit? How do you treat your wage subsidies? A lot of these factors and functions are an important consideration, especially in this year, and plan it out well for the next few years to come. I also want to briefly touch upon one of the points Udit mentioned, force majeure, some of the intercompany contracts, Canada being a contract, Canada being a legal over economic substance country, intercompany agreements become more important. Intercompany agreements are not always framed in the best of fashion and thought through every scenario. They have done with a very practical set of mind. Does not cover scenarios like this. How do you deal with a COVID situation? Is there losses that needs to be allocated, shared between related parties? Who bears that risk? Who should own that risk? And should that risk be shared with the Canadian taxpayer, or should that risk be with the Canadian taxpayer? The Canadian taxpayer is an entrepreneur or a service provider. So these are some of the questions. There are ways around force majeure. Maybe sometimes picking on force majeure clauses is not that easy from a legal perspective. What taxpayers could do is have a memorandum of understanding for a short period of time with their related parties. For this period of time, this is set aside, this MOU applies, and then we would get back to the intercompany agreements when things get normal. That's a workaround, and that's a more practical workaround. A lot of related parties or third parties are doing that in a commercial context. So.
Thank you very much, Vinu, for that clarification. Vijay, I understand we are slightly over time, so I don't think I have the liberty to go in for other questions. So I'll thank you, everyone, and I'll hand it back to Vijay to go through the rest.
Thanks, Pramodji. I think there was a lot of hesitation. Would we have any questions on a fairly complex subject like this? And the answer is yes. We have some questions from the audience. So one of the questions I think has been answered recently by both Therese and Vinu was in terms of in 2020, if there was a time for you to rethink or recalibrate or benchmark your policies for like transfer pricing, there's no better time than 2020, and basically because of COVID. I think that's what you guys all suggested as well. The question was, should corporates be encouraged to do a fresh benchmarking analysis this year specifically? I think the answer is yes, right? So this one more question is, given the cash crunch faced by multinationals, would re-engineering FAR be a good strategy to temporarily change the pricing policy and save on cash? Now, I don't know if we want to just go on that quickly, but I'll see. We'll see. Therese, you want to answer that quickly?
Sure, Vijay. And just so I can gain clarity on that question, is it with respect to re-engineering perhaps the company as a whole's functions, risks, and assets? Is that? Yeah. Okay. Got you. And absolutely, I think many companies now are hesitant to make these shifts. I sometimes call it big supply chain or shifts or value chain shifts. But I think if you are able to do that within your company, absolutely, because this is a way where you may want to downsize one of your plants in the US, for example, and probably increase capacity in India or another maybe lower tax jurisdiction. So this is an opportune time. And then again, it's going back to, if you do that, then this is where you need to have the documentation in place to tell that story. So again, in the event the CRA comes in the door, let's call it 5 years from now, you have that support.
Thank you very much. Vinu, do you want to add anything to that? Any opportunities? Let me rephrase it. Any opportunities out of transfer pricing, COVID, that people listening can think of as well? Like, obviously, in every crisis, there's also an opportunity, there's silver lining. So anything that you might want to say? Opportunities in this, Vinu?
Thanks, Vijay. Thanks for the question. Very briefly, I would say that every crisis brings a lot of opportunities and challenges, even for us as individuals, as service providers, as employees, and companies as well. Just to share a brief example with a client that I was talking today. This is a big multinational, has a lot of heavy manufacturing operations. They are in the aerospace industry. They recently shifted over to making what do you call respiratory equipments for COVID, and then they realized that they could repurpose their equipment so easily to do something different, and this made them think that can they become something different from what they are. This is the kind of opportunity that gives companies, even smaller companies, a way to rethink how they have been doing business. Can we change it? Can we look at things a little differently in light of this COVID scenario? Is there efficiencies that can be brought in within these restrictions? Because previously there were people in the US who used to travel into Canada. A lot of that is stopped now. People are not able to travel between countries. People are located in one jurisdiction. How does that impact transfer pricing? Should we now revisit the function analysis for 2020? Can this be the way things are going to change going forward? A lot of that, maybe we can convert an entity from limited risk or to see if it can be considered as taking on greater risk. One more comment I wanted to add was that the concept of limited risk, I see, is getting questioned very heavily. What does limited risk mean? Does that mean that the entity has no risk? Like, we're giving you a cost plus guaranteed margin. Limited risk does not essentially mean no risk. Limited risk means that there is some amount of risk that is borne by the entity that relates to the market risk. And that risk has its own financial impact, which is not so visible in good times, but more visible in these kind of scenarios.
We got to stop you there, Vinu, but thank you very much. We have one more question that came in. We'll just take a quick and because if we got Udit, will send this to you. I think somebody talked about government subsidies and government grants and during COVID times. Now the same thing is in forbearance for loans. If loans are getting moved, right, does that have an impact on transfer pricing as well? Because in different jurisdictions, if you have a company in the US, your company in India, your company in Canada, and your loans are your interest payments are waived in one of the countries, how does that work?
Ultimately, like when it's a very different question, like if it's provided by the government, the loans and all are being for the computation of margins and by vis-a-vis your companies are be taken as non-operating. It could be a bit technical for the non-transfer pricing guys. So I don't think it's going to give a big impact on the transfer pricing side. But yes, if you have given some loan to your related party, then there could be a question. But yes, if government have provided some kind of a subsidy to you, to what I understand, as Vinu have also mentioned, like there is a specific guideline TPM 17 specifically, and government have clarified that this kind of all the subsidies the government is providing won't be taken for a transfer pricing purpose. Oh, sorry, won't be taken for a transfer pricing purpose. But Vinu, just correct me. What I understand is like there is a line, and in India as well, I have specifically taken a case with CRA as well. Like you can always compare from apple to apple. Like if your comparable companies are taking that subsidy into their account, then you can also take that subsidy into your accounts. And but yes, if they are not taking, you can also avoid that subsidy. So I think that part can be avoided, or that can be adjusted in financial itself, because ultimately it's all about the comparables. If you are getting the subsidy, your comparables are also getting the subsidy. So if your comparable also getting a subsidy, you can subset that.
Thank you. We're absolutely out of time, but I think it's a great. We really thank the panelists. I think as we probably could have discussed this into the night, but we definitely don't have time. But we will definitely have all of you back again. We'd like to thank our sponsors, technology partner Tangentia. We also want to thank our annual sponsors, Turkish Airlines, TD Bank, by Peter and Paul's bronze sponsor. We also like to thank our sector sponsors, RBC, TELUS, Raymond James, SBI Bank, Canada Bank, the Seneca College, GT20, ICICI Bank, and our media partners, The Weekly Voice, Y Media, and PTC Punjabi. We also like to thank all of you in the audience. Those of you who joined us for the first time today, welcome. Those of you who are joining us over the last, little while as part of our Thursday talks, thank you very much for joining again. Any of you who joined today want to know more about today's webinar, want to know how to become a member of the ICCC, or want to know about the Small Businesses Program, please write to iccconline.org. And again, thank you very much, everybody. Pramodji, if you want to have a quick last say on this, over to you.
Thank you, Vijay. And on behalf of the Chamber, I would like to express sincere thanks to all the panelists for having taken the time and to be with us this afternoon. Thank you once again.
Thank you. Have a good evening, everybody.
I would like to say thank you, Pramodji and Vijay, for giving us this opportunity, all three of us, to be part of this presentation.
Thank you.
Thank you, Vinu.
Thank you.
Thank you.
Thank you.